This is James Flanagan with Gain Global Financial with your webinar presentation coming to you on Thursday, November 9th. And in preparation for this morning, I started to get a little bit philosophical with regard to my history in the newsletter writing industry, which started in 1990. I started in the brokerage industry in 1980. And what has transpired over the last 27 years, and I want to share a little bit about that with you. And in starting, and you'll kind of get my line of reasoning in a minute. I in doing the initial invitation for the webinar, I was fortunate enough to have been had Bob Moriarty at 321 Gold. That's his website, also 321 Energy. And he had written this article in February of 2016, and I told you about it. I was not familiar with Bob at the time, and so out of the blue, he had published this article, and then I just got bombed, I don't know, by 700 people. And in it, he says that, he's been in the industry for quite some time. And as I'd mentioned, that he had said that I had called the 2001 low in the silver market, also the 2011 high. And he was saying this on February 1st because we had just established our low on January 19th in the precious metals and the precious metal stocks, and over the course of the next 6 months, the market would advance 188%. So he wanted his people to see what I was saying with respect to my bullish analysis. So in looking at these, so what I did just this morning, I pulled up the October 2001 newsletter, my newsletter from Past, Present, Futures. And I want to say up front that it's not rocket science what I do. Really, I just have been enterprising enough to accumulate as much history as I possibly could. I'd set out early on in my 20s. I'm 60 now, and said I'm going to acquire as much data as I can going back in history, because certain things only happen once every 3 generations or every generation, and I wanted to be aware of what occurred during wars, what occurs during inflations, what occurs in the aftermath of them. And the result of that is that I'm able to make forecasts and have had a pretty good degree of success. And this was the October 2001 issue of our newsletter at the time, and I had overlaid the bear market from 1980 into what was at this point November of 2001. And the bull market top in 1919, which was exactly 60 years previous, and the final low in November of 1991. And I was telling subscribers that once the low was in place, that we were going to see one of the great bull markets in history. Now, this is based on the 60-year great cycle. So as I said, this is the only commodity on the board we view as a safe harbor, but one which has the potential to advance regardless of what happens in the stock market or overall commodities. In our May issue, we said, as the pendulum of value continues to shift away from the stock market in favor of commodities, we believe the silver will be a key component in our strategy to profit. Now, that was at the point of the final low before the great bull market. Here was the November low. What would wind up being 1,031% advance in 9 years and 4 months into the 2011 high. Now, Bob in that article also mentions this 2011 high. But I just wanted you to know that by virtue of knowing that 60-year cycle, and there was other factors as well, and they were all converging, that this was an easy forecast to make, and expecting to see one of the great bull markets in history. Now, in 2011, my research into other runaway advances in history, we had silver, back-to-back legs of 79% in 5 months, 6 days, and then 89% in 2 months and 30 days. So this is a chart that I provided to subscribers at that time. And what we found is that when markets experience this type of first sell-off, minus 33% in 23 days, that marked the end of the great bull market. So some of the things I said, the greatest percentage advances during final legs to the upside have always experienced wicked initial sell-offs. That was said on April 16th, so 9 days before the high. Silver and cotton have been the leaders in the commodity bull market off the 2008 lows with advances of 493%. That was the overall advance here, and 519% respectively. The dramatic sell-off in these two leaders is an important indication we have a final top in place in overall commodity prices. Now, this is before, we experience, let me find the chart here, this great historic bear market that we experienced. So we're looking at the evidence based on history, and price is a reflection of people. It's a reflection of greeds and hopes and false hopes and panic and all of those emotions that people have. And history is a real grounding force, and to know what history indicates, and to the buyer beware. One of the things that had happened, I had my oldest friend from childhood called me when the silver market was at $38. And he told me, he said, I just bought a boatload of silver. Now, by the time that you move from 2008 up until 2011, everyone knows that the silver is in a bull market, and everyone clamors on board. It's all the buzz, and this is what took place at the stock market at the 2000 highs, and I mean, it goes over and over again, and it grieved me to hear him saying this. I didn't know what to tell him, and I knew that this was he was in for real trouble, relative neophyte, but based on history, I knew that the zenith of this bull was getting very close. And so one of the things that I do in the service is I attempt to catalog history and to arm my subscribers with an understanding of what history says about different situations. So, for example, in the current the title to this webinar, the 7 situations where we've seen a scenario like we're currently experiencing, all of which have a consensus that something is going to happen. And that's really important to know from history. So, prices are made up of people, mass psychology plays out. You see these, large waves of, advance, and then these historic bears, and history has a lot to say about these. So in the aftermath of this, we saw this initial sell-off. Those initial sell-offs, these are all historic silver moves. So after the first legs down, the 1974, 1983, 2008, even 1864. So I've got daily data back to about 1812 in the cotton, the grains, agriculturals from 1858. Because the more data you have, as W.D. Gann says, the better armed you are in the markets. And so the bear market rally did indeed come into play after this April 25th high. Let me see if I can get here. Okay, so this was this first leg down. Here was the target zone. And the rest is history, down 73% in 4 years and 8 months. So we have to reverse this, this propensity to buy during bullish euphoria, and to exit in despondency because the market has come down 73%. And one of the, as I say philosophically, I said that up front, one of the realities of my business as a publisher, and the attrition rate is very high, which is to say that with a good stock market newsletter that is an interesting read, something that is not just market centric, but is an interesting read. You may not know this, but the renewal rates are about 60%. Now, stock letters are less expensive. In my business, the renewal rates can be anywhere from 25 to 40%. And there's a lot of reasons for that. When people come into the market, if they're unsophisticated, they lose their money very quickly, or they overtrade, or they typically overtrading is the biggest danger, and they're expecting something on the order of a bull market, let's just say like this, or a bear market like this to occur every day, and it just doesn't. So one of the things that happens with my subscribers, they get tired of waiting around. My philosophy is, wait for the major plays, be patient, and don't chop yourself up in the meanwhile. So what's happened, the tail of the tape was that, this major low I was able to call based upon history. Also this top in 2008 All of my stuff said there was going to be a major meltdown in commodity prices because of what happened in 1921 and 2000, 1921 and 1948. At this low here in 2008 was the bottom of the 60-year cycle in the stock market. That suggested that we were going to see one of the greatest bull markets in history in stocks. The rest is history on that. And so the value of what I do is most keen in terms of picking major turning points. And I say that from the standpoint that all of history will align at those points. And this is what happened at the 2016 low when Bob published this article. Now, we need to know something about inflation as a backdrop in terms of the ebb and flow of inflation and deflation. And this is a commodity index that goes back prior to the Revolutionary War. And we've had 7 major inflations in history. And these are interrupted by major deflations, minus 78%, 69, 80%, 75, 31. Very modest from 1951 to 1968, 50% from 1980 to 1998, and then a whopping 70% into the January of 2016 low. So what we're presented with is when is the likely next major inflationary move going to take place? Now, one of the things that we do know over history, because of the inflationary policies, of the federal government, and this really started with FDR in the 1930s with the New Deal. Now, the first 5 months of our income goes to just paying off the government, paying the government in taxes. And so things have gotten a lot more volatile. And I'm going to talk a little bit about my background in growing up in a family that was in the gloom and doom camp, that, the sky's falling and all, hell's going to break loose, that kind of thing. I'll probably do that in the second video. There's going to be some follow-up videos to this. In the meanwhile, the question is, at different points in time, many analysts, the gloom and doomers in 1980, were saying, this is it. This is the last train out. This markets are going to go up. There's just going to be a crash, a calamity in the United States, and that type of thing. And of course, that passed with a 18-year deflation in 1998. The next major inflation into 2008. That's when the crude oil topped. Silver topped out in 2011. Now we have this huge deflation that's taken place. Well, here's the Barron's Gold Stock Index. Almost unimaginable for the bulls in seeing off this 2011 top that the market would come down 85% into this January 22nd, 2016 low. That is, in my estimation, a defining historic low that we will not see again. Now, 245.05 in the Barron's, just a little bit above the 2000 low. So it gave up everything from 2000 to 2016, which is incredible. You think in terms of the federal debt going up to $20 trillion, doubling in the Obama administration. Every administration has not reined in spending for the government, and really just off of the 1976 lows. So we had this blood in the streets decline in precious metal stocks, which is important to note. From there, the market did exactly what it does in the aftermath of these type of deflationary moves. Now, in this table, what I have is the 34 instances in history where a commodity or financial market like the stock market has declined at least 74%. And I've sorted them by percentage declines. So, for example, the S&P 500 into the Great Depression lows was minus 86%. That ranked at number 7. Looks like I may have cut off a few at the top here because it's starting at number 3. Apologize for that, but there's a total of 34. Well, this gold stock index weighs in at number 9, minus 84%. On this side of the table, now this is the table that was presented to subscribers before the advance started off the January lows. And by the law of action and reaction, which in kind of common terms is, the bigger the bull, the bigger the bear, and the bigger the bear, the bigger the bull. And that is empirically, I've proved that. in taking, these greatest bear markets. This goes back, I've looked at all of my data back to the early 1800s, and these are the top 34. And they were preceded by major bull markets. So many of these, as you would imagine, were declines during the great deflations in history, where all the markets, each of the individual markets was, pulled down in a major deflationary, you know, uh, decline, or in a, euphoric, the bull markets in a euphoric bull type situation. But what we knew in the aftermath of bear markets on this order is that major spikes up occurred in price. And typically they retrace 59% of the preceding decline. The average rally after deflationary declines like this was 241% to the upside. So what we anticipated and what one would anticipate, and it happens in every instance. If you look at these and you pause this, you'll see, well, here's the the sugar market advanced 652%, 195, 206, 230, 177, 506. So, as I sit here, I can tell subscribers, I say, just maintain your subscription. These situations are going to occur. It's okay if you don't do anything. You can even say that in terms of for years in waiting for these major situations to shape up. And, that's the real rub of it. When we look at what's taken place, major buy in 2001 in the silver, major sell in 2008, major buy in 2009, major sell in 2011, major buy in 2016. That's five major plays in 17 years. Yet we get so caught up, people get so caught up in the intensity and watching the markets during the day, over trading, and all those kind of things. And it's not healthy. It's not healthy, and a lot of you know what I'm talking about. And I do believe that being out of the market from the for certainly as a speculator, but there's times that simply being out of the market is a very healthy thing to do, because the market's not going anywhere. It's basing or it's going through distribution. And those are periods that you can stand aside, certainly have modest expectations on profits. But then there's situations that come up like 2016 that are just off the charts. And those are the type of situations that, that gosh, those are the situations that are most important to me. And by the way, can have the greatest impact on my subscribers' portfolios. The 10,000, the 1,000% appreciation in silver. That's not even to mention what the precious metal stocks did, which had much greater leverage, much greater multiples. But when we line up history like this, and I just do it over and over and over again, I have a research engine which allows me to do forensics in the markets, and the idea is to ideally isolate historic situations. Now, here's here's, for example, a chart that I showed subscribers. We were fortunate enough to purchase, right after the lows, before the market advanced 288%. But here's the median rally in history based upon both price and time. So there was no mystery that the market was going to experience, this huge 188% advance, which retraced a modest 35% of this entire decline. And in the aftermath of that, a 44% decline. This is certainly not business as usual. This hasn't been business as usual. The magnitude of this bull market, the magnitude of this bear market, this micro bull market, runaway advance of 188%. And in the aftermath of this, what we have is, here's my homework assignment. Well, James, after the greatest bull markets in history, going back to the 1800s, any market from heating oil to sugar to the stock, because there's not that many. So you can't get perspective in a market like the gold stocks without at times getting outside of that market, because sometimes things can be so historic that you have to see how the participants and how the markets played out in an outside market. That can be the silver market, which is, by the way, the closest fit precedent to this in history. So I started with 12 precedents. It narrowed down to seven precedents, and then there's one that is the closest fit precedent in history, and that was the silver in 1983, and we'll get into some of the details of that. Also, the platinum, very close, because there is DNA in this market that is in these other markets, and you have to get outside of that primary market in order to keep your head screwed on and get an idea of what can happen in moving forward. So one of the 7 markets is the Great Bull Market during the 1929 advance. So I'd said this in the invitation that the advance that we had experienced in 2011, these are the comparable moves in history. Was the Roaring 20s bull market and the Great Depression, which followed. And so the 84% decline that we experienced in the HUI Gold Stock Index, I've got to go to the stock market. These outside markets see 86% decline. In the aftermath of that 86% decline, what did the market do? Went up 177% in 1 year and 1 month. These are astounding percentage moves in a short period of time. Then the market experienced this sideways to lower, minus 34%. And then the next major run, which I think was approximately 170%, I'll get to that in a minute. So looking at our 2011 high, equating that to the 1929 high, it places us at this point at which this purchase level occurred, in the stock market. But I'm going to show an overlay on the chart in a minute. Now turning to the silver, here's up 1,225%. The 1980 high. In the aftermath, this is the bunker hunt, his attempted, corner of the market. When the corner was broken, when they changed the rules on the New York Stock, the COMEX exchange, and said liquidation only orders down 80% in 2 months and 9 days. And when you look at these spike highs, these major highs, just like the 2011 high, I was aware, that once that first leg down occurs, in every instance it sets the stage for a secondary rally, and then just down she comes. This is one of the great initial legs down in any bear market in history. In fact, it may be the greatest, but there are others that are for the record books as well. From the 1980 high, then ultimately we dropped from $50.36 to $4.81. And then we had this runaway move, 7 months, 25 days, 206%. This is one of the, was the key market that alerted us that we could experience a move on this order in our market, because that's what happens after historic bulls, historic bears. They are subject to moves like this. Now, these kind of moves are going to be with us, as long as we live. However, one has to discriminate and wait for these kind of moves. I just wish that my subscribers would, okay, don't, yeah, sure, do some trading, if in your own right, if you know what you're doing, if you have a strategy, if you're implementing a plan, all those things that can lead to success. But the greatest benefit that I've had to subscribers, since publishing in 1990, is when I can give a 2001 buy in silver, 2007 sell, and a 2016 buy. And I wish my subscribers did nothing else, in one sense, than to just wait for those situations, because they're going to come. And so this is what I search history for, these extraordinary type situations that come into play. Now, since this 1980 high, we see that the final low wasn't until 1986, and then 137% advance. We're at this approximate point at which this low was established, and like the stock market, I'll show that to you in a minute. So here we have the market having experienced, this is the HUI Gold Stock Index again, minus 44%. Then we see the market surge 39% to the upside, and it's been trailing off and trading sideways now, really since, we'll say, January of last year. So we're coming up on 1 year of the market offering no real opportunity other than trading opportunities, and one would have to say that they're very modest opportunities at that. Now, in the aftermath, as this 2016 move occurred, I checked my renewal rates, and unfortunately, subscribers have a way of hurting themselves along the way, or I can say that becoming apathetic about the markets, an inability to be patient and wait for the major moves, I think that's a big part of it. But if the philosophy is to participate in the major moves in history, then by and turning points, determining major turning points, then by definition you have to be patient, and that requires that you're out of the market sometimes and preparing, in a sense, but anticipating that these type of moves are going to occur. So here was the runaway advance off the lows, 188%. My buy recommendation was made at 106, so it would have been right in here. The market had broken, this triple bottom here, so they ran all the stops here. In fact, the XAU broke the 2000 low. So as soon as it reversed from there, I said, okay, that's it. They've cleaned out all the weak-handed longs on this classic bear trap, and then it was off to the races to the upside. Now, I want to just go in brief and say what some of the things that I've said since then. During this decline here into the December 15th low, this is a 44% decline which took place. There's never been a correction in history in precious metal stocks that's declined 44%. So there was many things that was alerting me to the fact that, okay, this is very likely that this is a very important top. It's not that this is a correction and a bull market is going to be resumed. I was telling subscribers very low probability for that. When it rallied to the February 8th high, I said this is the target. I'd put this as a target zone because this is typical of what a rally would be. I think the target was between 35 and 45%. I think we rallied 39% into this high. And then more recently, when we made this slightly lower top, I said, I have nothing that is telling me that this market is going to push over the top and continue higher at this stage. And one of the things that I said in the aftermath when it started to come down, I said, boy, I would have really looked stupid if it continued higher, because I had zero historic precedents that said that this market would continue higher from here. Now, in saying that, earlier back here in May, I did have two precedents that conceivably could result in this being a first leg up, complex side trade. This was in 1932 in the corn market. So here again, I'm gleaning from history and saying, okay, when does the DNA in our market match that of what is historically the DNA? I just want to interject one thing real quick. We are going to be going through a name change, and the new website domain is called Market Forensics. And so early next year, that's going to be launched. It's going to be the same, same information from the standpoint of, the analysis and that type of thing. But it's I'm much more involved in looking at the forensics of a market, not just based on price action, but also based on sentiment. And may be able to show you a few things in the subscriber caliber videos that will be forthcoming. But this 1932 corn bottomed in May, and then we also had in 2002 the precious metal stocks. This was the second greatest correction in history, which occurred in 2002. And there, too, a final low was made in May, and both these precedents called for 130% advance. I told subscribers at the time, I said, I think it's a 10% probability that something like this could happen. These advances, which took place in both the corn and the gold stock index, this was the XAU, they occurred against the backdrop of major inflationary moves where all commodities were being swept higher. The 2002 move, very early in the great inflation from 2001 to 2008. And so on that basis, I was dismissive of the likelihood that this advance would continue. And so as the market, had continued off to the side, you can see that the market is obviously wringing out all of the bullish enthusiasm that took place into this August 4th high. It's wearing investors and traders out. That's what the markets do. There's this expectation often that traders have that, well, they extrapolate the present indefinitely into the future, and they're trading, the market currently as though it was this situation back here, or what occurred at some other time. But the reality is that we have to know when a market, there's a jump off point where the market is really ready to go and experience 130% advance. So these were 2 precedents out of 13 that I had, but the other precedents argued against something on this order taking place. So I viewed it as a low priority probability for a lot of other reasons as well. Now, in looking at the bull market that we experienced into the 2011 advance, these are the 4 closest fits. In history, the bear markets that unfolded in the aftermath of both bull markets of the order that we saw in 2001, bear markets in the order of what we have seen in our market into 2016, and in the midst of it, a spike up in price on the order of this 188% advance. Now, in this target zone down here, what we have is when the bottoms of these markets were established. So you can see, for example, this is the silver in 1980. It actually retraced all the way to its lows that were established in 1982. It tested the lows in 1986, and then 132% advance. Gold stocks, 141% advance 1 year, 1 month. S&P 500, 132% advance in 2 years, 0 months. Platinum, 188% advance in 1 year, 6 months. So these are very credible, relatively short-lived, what I call micro bull markets, but nonetheless very robust. So the strategically, what I'm looking to do for subscribers is to look for when this final low will occur in expectation that the market does just what the market does. Now, there has been some shifts that I've made over the last about 3 weeks. There's been additional evidence that's been forthcoming in the markets. There is obviously an element of needing to be flexible and with respect to what can be taking place. And I do think that at present that it's likely that we're at an inflection point, and I'll tell you why. So in utilizing the research engine and the forensic analysis that I do, one of the things this is called a market average chart. I always am apprised with this chart of what a typical correction looks like versus an impulse leg to the downside. So we see, for example, this is the gold market now. December 15th was the low, and we had a higher bottom on July 10th. A median leg up, the typical leg up, is 25%, but the gold was only able to muster a 13% advance. It was also only able to, on this leg here, up 15%. And on that basis, I had looked at all of the back-to-back legs, modest legs like this, since they're some of the smallest legs up in history. This one ranked at number 42 of 49 based on 13%. This ranked at number 36 of 48. Very modest legs in the gold market. So these are not robust legs up. This is not, an aggressive bull market, not a normal bull market. If this is part of a bull market, it's really been pathetic. In fact, the precious metal stocks made a lower top, so now you have divergence. Gold going to new highs, precious metal stocks having no part of it. This is not what you like to see if you're a bull. You like to see that the gold and the gold stocks are in lockstep. This means that there's tension. In terms of there's a tug of war going on between bulls and bears. The market is in essentially an equilibrium level, and so during this leg up, my work said that okay, it's very likely, based upon this modest leg up, that this leg up should be modest as well. That's just simply history. Now, in the aftermath of that, now we have this sell-off that right at this blue dot here. That would be a median retracement or correction of this initial leg up, and you can see there's been 41 since 1968, and we're right on the money for what a normal correction is. What that means is that if we continue lower, then we're going to start taking on the DNA of an impulse leg to the downside, and that's very problematic for the bulls. So you can see that we're at a strategic point in terms of what's going to take place next. Now, at the same time, here's the HUI Gold Stock Index, as noted, lower top in September, below the February top. So here was the February high in gold, 1263.80. The gold market makes a $90 higher top, and the gold stocks make a lower top. That's problematic. Now, since then, gold stocks have declined 16%. Gold has declined 7%. So even during this recent decline, more relative weakness. Not what you want to see as a bull. And up until the last couple of weeks, all the evidence that I have for precious metal stocks is that I would say in total is that the market was going to continue lower, and that was the hope, that the stage would be set for a major buying opportunity in precious metal stocks and precious metals as well, and for it to occur at the point of capitulation where the public and the perennial bulls all go through some kind of horrific house cleaning decline, because that's when you want to buy. Typically, is you want to buy when others are selling. That's always the case if you're looking for a major turning point at a low. Now, in looking at the gold stocks, here would be a median correction. This is the decline thus far into November 3rd low. Gold is still holding its October 6th low, and a median leg down would result in a 33% leg down. So you can see that we're following what would be typical if this is a leg down. And that would easily break this December 15th low. Ideally, I'd like to see that happen. In fact, an argument can be made, or it should be made, on the basis of those four closest historic precedents, that if there can be one more severe liquidation in this market, that could set the stage for this type of advance. I believe that that's the odds-on favorite. Now, in looking at the HUI, we have retraced 84% of this leg up. And that ranks at number 12 of 44 legs up since 1939. That's taking the Barron's Gold Stock Index back from 1939. So we can also say if this market continues lower, then the retracement is going to become greater. If we break this July 10th low, that means we're making a lower low. And that would fit into this, the likelihood that we're going to go lower in the precious metal stocks and the gold. But let me say this, that if the precious metal stocks and gold were to hold here, and we're in the target zone, I would have to say that, and reverse higher, well, something unprecedented in many respects would be taking place, but I can't rule it out at this point in time. If this, for all intents and purposes, we hold these levels and we break above this double top, that's going to be decidedly bullish, and I would say that we have lows in place, and precious metal stocks are going higher. So is this a correction, or is it an impulse leg down? we're at the point in time to find out. Now, we also know in looking at precious metal stocks since 1939 that the percentage retracements, we see that 84% of them are between 80 and 89%. Now, we've been at 84%. If we retrace as much as 90%, it goes to 91%. So you can see that this is not ideal DNA for a bull market. It is definitely more akin to a bear market, which would tip the scales to the likelihood that this is an impulse leg down. We're going to break this July 10th low. And as I said, if we break this July 10th low, I don't think there's any doubt in my mind that this December 15th low would be broken. And if that is broken, okay, that's where the weak-handed longs are going to be bailing out and washing their hands. I've had enough of this. I hate gold stocks. That's that's what happens in the markets. That's where, my friend who buys silver at $37 and then it comes down to, whatever it came down to this time. And it's just like, okay, I've had enough. This is, I've been sitting on this thing for 4 years. And this is something you never want to get caught into and sitting through something, because not only is it going to wear you out and, and wipe you out, but you're going to miss the key opportunity that's coming up. Now, also in looking at the duration of, now this is the duration of bear market rallies. Now, I'm not sure if that is relevant to what we're saying. We do see that this rally here into September 7th fit very nicely into what a typical bear market, actually number 14 of 42 based on duration, so it's a little longer than is typical. But overall, the DNA is decidedly on the negative side. Now, as we look at the gold market, we have a interesting short-term pattern, which I think is going to be telling. The recent decline, September 8th to October 6th, pretty sharp sell-off, less than a month, and the low at 1260.16. From there, the market rallied to 1306, retraced to 1263. This is a couple of days behind. I think we closed at about 1284, so we're somewhere right in here. But by virtue of this 1263.35, we know that those that are trading the market are very well aware that there's this minor double bottom down here. On the basis of that, I always expect well-defined lows to be broken fractionally before a legitimate reversal takes place to the upside. So if this does and were to be cataloged as a correction followed by a leg to the upside, I would expect this is the cash 1260.16, to be broken first. It doesn't always happen, but that would be what would be expected, and I'll tell you why in a minute. If from there we were to exceed this 1357.54, which broke the election night high by $20, so cleaned out anyone who had sold gold from the point of the presidential election and beyond. So, ran all the stops above the highs. That's a bull trap. That's a failure. Reversal to the downside. If we were to put a corrective low in here, then I would expect the next leg to eclipse this July 6th high, which is the high for the move. So very important place that we currently find ourselves. Now, in this table, what I've cataloged is in every correction in history in the gold market, what you find is in 25 of 30 instances, which I'll show in that table, there's a preceding low that's broken, followed by a reversal to the upside, a low that is typically very significant. So in this case, there was this May low. It was fractionally broken, bear trap, run all the stops underneath the low, a reversal higher, and that is a signature of the completion of corrective lows in the gold market. So if we go back to 1985, we see that an initial low is established like this October 6th low. And those that, in the instances where that low is broken, 1 month or longer from that initial low, that's what I refer to as an intermediate bear trap. And so you can see that most instances gold experiences that. Other instances, it can be a break of a low, and it might be 2 weeks after the initial low, but it is of significance. And then there's only 5 instances where, let's just say that the gold continued higher from here and didn't break this October 6th low. There's only 5 of 30 instances since 1985 where that's happened. So it can happen, but the odds-on favorite is that this October, even if you're bullish, that this October 6th low will be broken before the market advances. So if I was looking to be a buyer at this stage, and I could be a buyer, it's very possible, then on a break of October 6th by at least $2, if the market reverses higher, at that stage I could be a buyer with a well-defined risk as far as a sell stop. On the other hand, if that low is broken with follow through to the downside, well, the question has to be asked, well, what's that going to do to the HUI Gold Stock Index? And the answer to that is you would say that, well, it's going to take some heat. That means this will have retraced more than 84%. And now, we've traded within, 7 points of the July 10th low. And so you see how if this gold breaks this low with follow through, it's going to be very problematic for gold stocks and likely indicate more work needs to be done to the downside. Now, I kind of look at it as though you have this bullish and bearish ledger when you're looking at the market, that it's usually not universally bullish. Everything is just, pointing, in one direction. There are, some things that, that are problematic. And in terms of and I have got a ton of things on the bear side of the equation in the precious metals, even though I believe this is a basing pattern. So I'm not bearish from the standpoint that I believe that the January lows are going to be broken. This market's going to, really hit the skids from here. I don't believe that's going to happen. However, we are in a basing pattern, and it's extended out 2 years now. And so on that basis, we can see, another significant move down, leg down within the overall basing process. That's a possibility. Now, one of the things that I had to put onto the bull side of the ledger is the dollar index. And after establishing the January 3rd high, slightly lower top on March 2nd, this has all the earmarks of a leg down in a bear market. So on that basis, in fact, the recent advance in the dollar has coincided with the recent decline in the gold, almost identical. They're almost reverse images of each other. And if this is a bear market rally, the median rally would have been complete as of October 22nd. Our high is on November 7th. So if this is a bear market rally, which is going to be followed by the resumption of the bear market, another leg down, that would be supportive of the idea that the gold correction is going to be complete and the market is going to move to the upside. So we have some very strategic overhead prices here, both in the gold. If we break above this 1357 decisive breakout, it's just another $17 to this July 6th top. If it, the more quickly it did that, if it was to do that, then the more legs it can get to the upside. And this would mark the trading range highs, in my estimation, July 6th. So if we get above that, then indeed we would be, would be cataloged as a continued bull market. So again, we're in a very strategic place with respect to what can take place from here. So, to recap, my expectation had been that in the aftermath of August 4th, this market had a low probability of continuing the bull market. The probability was that more work would be done to the downside. That would make it very difficult on the bulls. And it has been a difficult environment, unless it's just, you're buying and holding, but it's a trading type market. And this December 15th low is a marker for us. We can be assured that if we break that low, and it's, again, this 44% decline that we occurred off the top, that's not, that is highly irregular. Now, I had gone in every market back to the cotton in 1812, and I said, when was the last time a market retraced 44% of, when it had a leg? It wasn't even on this order, but great legs up in history. how frequently does a market experience a 44% decline? I'll have to look at that work, but it doesn't happen. It means that this was in a strong position at this stage, then it shouldn't have declined 44% because it just doesn't happen historically in markets with similar DNA. What's been borne out since then is that yes, indeed, there was no way that this was going to continue in a bull market. Too much damage done on this decline, and the market, psychology experiencing some damage, obviously, and now the bulls are on their heels again with this recent decline. And they're really going to be on their heels on a break of December 15th. And there's a very real chance that can take place. So what I intend to do is I am going to be following up with some additional videos and over the course of the next week. Many of you have tuned in before, so you know that we publish subscriber caliber video updates after the initial webinar. And one of the things is to just simply give a lot of information that hopefully is valuable, whether you subscribe or not. But one of the things that I'll be looking at is the potential downside in the precious metal stocks if the market breaks the July 10th low at 177.41. So if we do break this low, as I said, I believe the December 15th low will be broken, but the decline can be relatively short-lived. It can be, just basically clean house on weak-handed longs and set the stage for a potential major buying opportunity. Also, I'm going to touch on interest rates and what they tell us about the financial stability of the United States. I had, thought I didn't know how this particular webinar was going to play out. I didn't know whether I would touch on the stock market, but I have so much information to convey in the precious metals. I am setting the stock market analysis aside for another video. And there's 5 periods since 1789 in the stock market when we've had wealth building cycles like this. I'm going to show you what they are. We've now passed what was a 7th-year danger period in the stock market. I'll be talking about that, and I think you're going to find that rather fascinating. And finally, I put this down. I was taking a walk today, and I've never shared this, but I actually grew up in a family and grew up in the world of the so-called gloom and doomers. Back in the 1960s and 70s, my dad, he had purchased gold when it was $35 an ounce, and is still holding that gold. And at the time, I had involvement in some of the key newsletter writers were family acquaintances at the time, and it's undoubtedly the reason that I'm in the industry. And Harry Brown, Gary North, R.E. McMaster, and various others that I'd gotten to know back, in my 20s when I was initially interested in this. And so I've got an interesting take on what can take place from here with respect to the future of the U.S. economy. And I think that as you like myself, we're concerned about what the future holds, and we should be, and how to protect our wealth and how to maximize the opportunities with respect to when they come. And in light of the mismanagement, of the U.S. economy and government, unhindered at this point in time. Yes, there's going to be a piper paid. We know that it is going to happen at some point in the future. Can the market at some point decouple from what the norms of history are? Well, certainly we'll know it if it happens. And as I line up, and one of the things that I found is that when a market doesn't do something that it should, that usually means that there's something significant afoot. At any rate, we'll talk about some of those things in moving forward, and I think as of Monday will be the first subscriber caliber update. So at any rate, fascinating place that we find ourselves historically, the place that, times that we live right now, and the opportunity that's presented in the markets, and hopefully I'll be able to provide some insight that'll be of help to you. So I'll look forward to touching base with you as of Monday with the next subscriber caliber update, and certainly appreciate opportunity to address you this afternoon. Have a good day and profitable trading.